Okay, ladies and gents, this is lesson 2 out of chapter 7. We're going to be looking at the statement of receipts and payments. So what do we know so far? Cash receipts journal records all cash inflows of cash. A cash payments journal records all outflows of cash. So what are we doing now? I'm going to show you how to use the information in the cash receipts journal and cash payments journal to create a report that is relevant to decision making. Essentially, we are transforming data into information. So guys, this is what a statement of receipts and payments look like. It tells you all the inflows of cash, all the outflows of cash. If there's a surplus or a deficit in cash, which we'll go into detail very shortly. It has your bank balance at start, and then you simply add the two together, and it'll tell you your bank balance at end. So this is a way that we can find out what our updated bank account looks like. Alright, so as you can see, all these cash receipts that equal to 5,210 come from our cash receipts journal from earlier. One thing you should probably notice, that's why it's highlighted in red, is capital contribution. Here, it's in red for $700. The reason why it's highlighted in red is because normally what people do is just get painting fees, GST. When it comes to stuff in the sundries column, you do not list it as sundries. You have to write down what the actual item is. So I'll show you in a second when it comes to cash payments why it's important. So yeah, as you can see, you can double check that everything's correct. 4,000, 410, 700, 4,100, 700, 410, 5210, 5210. Perfect. Cash payments, same deal again. Just pull out the totals from the columns. Except for sundries, you want to list them out individually. So in this case, it's new equipment and van service. Why it's important that you list them out individually is because if you just write sundries here, when you're looking through this report, you'll have no idea what you were paying for or what you were receiving money for. So that's why we have to list them out individually when it comes to sundry items. Alright? And as before, total amount paid is $5,000 equals the same amount in our cash payments journal, $5,000. Voila. How do we get a cash surplus or deficit? Simply cash receipts, take away cash payments. In this case, 5,210, take away 5,000, gives us 210. Alright, so at the bank at start, you'll find it somewhere in the question. It'll tell you what it is. So our balance was 420. If you add 420 with 210, that's how we get our end bank account of $630. Alrighty, so that's a statement of receipts and payments. So cash surplus is a situation where an excess of cash receipts over cash payments, leading to an increase in a positive bank balance or a decrease in a bank overdraft. So what we're saying, guys, is where your inflows are greater than your outflows. Alright, while cash deficit is the opposite. An excess of cash payments over cash receipts, leading to a decrease in a positive bank balance or an increase in a bank overdraft. So this is where your cash payments during the period is greater than your cash receipts. And that might reduce your positive bank balance or increase your bank overdraft. So a cash flow statement is the next report we're looking into. This one is the most important report because this is what you're going to be using in Year 12. So what is a cash flow statement? It's an account report that reports all cash flows during a reporting period, classified as operating, investing, and financing activities. So it's very similar to a statement of receipts and payments. So we break it off into 3 categories. We've got operating activities, which records the day-to-day transactions. You got investing activities, which records all purchase and selling of non-current assets. And you got financing activities, which relates to money coming in and out, either through the bank or through the owner. And this is what a cash flow statement looks like. So as you can see, it's very similar to a statement of receipts and payments. It tells us what our surplus or deficit is. It tells us our bank balance at start, and you add the two together and gives you your bank balance at end. Alright, same deal. The only difference between them is we just separate them into 3 sections. Alright, some other things we have to point out. So you got your operating activities, so everything to do with the day-to-day transactions is recorded here. You're going to notice that all the inflows are recorded first, and then they put a total here. Then next they put all the outflows. Now what you've probably noticed is all the outflows have brackets around it. That represents money leaving the business or a negative value occurring. So they put all the outflows in brackets. This is something you have to do for a cash flow statement. And in the end, they put in the total outflows here. The difference between 4510 and 2600 is 1910. So this is where the columns come into play. The new one, net cash from operating activities, telling us how much money we've made from operating activities. We've made 1910. Alright, and then we do the same again for the next column. So investing activities, we got here, we just had an outflow of 1500. So because there's only one item, we put on the far right. If there's a few items, we have to put them all in the left hand side, then put the grand total on the right hand side. And since, you know, it's only equipment, there's one item, the net cash flows from investing activities is going to be negative 1500. So we've spent more than we made in investing activities, which is normal. And then lastly, cash flows from finance activities. You're going to see that the only inflow was $700 and the only outflow was $900 for drawing. So they put them on the far right. Net difference between that is negative 200. So in the financing sector, we've used $200 more than we've actually received. Alright, so that's our net increase from financing activities, which is negative. Next, we need to find an overall net increase in the cash or decrease in the cash position. So all you do is add the net cash flow from this, add the net cash flow from this, and add the net cash flow from this. And you'll find that overall we had an increase of $210. So we had a surplus of $210. Add the bank balance at start together with the increase in cash position, and that's how we get our bank balance at end. Alright, sometimes this number can be negative, and that will force our bank balance at end to be negative also. So why is it important, this cash flow statement? By breaking it up like this, it might make it easier for you to go, oh, okay, operating activities are done well. Something's gone wrong in investing activities. Maybe we have to do something to reduce this number. Generally, investing activities will be negative because you tend to sell your assets. I mean, you tend to buy more assets than you would sell because it'll help the business increase its performance and its position. So probably a better idea is look at the cash flow from financing activities. So if you might see that, you know, you're negative a few $1,000s here, by seeing this on this report, you might say to yourself, do we really need that much drawings? Is there something we can do? Do we have to increase our capital contribution to solve this problem to make our bank balance better? So that's a way that we aid decision making through this report. Helps them determine if they meet their cash targets. So guys, later on we're going to look at budgeting. So sometimes they have a budgeted cash flow, so they're going to try and determine how much money they're going to spend and how much they're going to receive for a period. If the forecast they made is different to the actual amount they made, whether it be positive or negative repercussions, or let me say that again, as a result of positive or negative factors, they could determine why it occurred and try to improve their budgets to ensure that it's more accurate the next time around. Alright. Another reason, assist in future cash activities. So when it comes to buying new equipment or stuff like that, any new non-current asset, if we can see our bank balance is positive throughout the period, maybe we can afford to buy a new asset to improve the business's position. Or it might tell us that we do not have the sort of cash to buy new assets, and we might have to look at cash flows from finance activities such as borrowing from a loan in order to fulfill our investment obligations or commitments. That's everything you need to know about the importance of cash flow. And that's it. Good luck.